Hello everyone, thank you for joining me. This video will show a very simple strategy to grow an investment portfolio to over $1 million just by saving $10 a day. This does not include any market timing, no stock picking, no financial analysis, and no Bitcoin or other cryptocurrencies. The reason I'm making this video is to show to my kids, their friends, and anybody starting out in the investing world that if they save regularly, invest early, and have some patience, they can grow their investment portfolio to over $1 million. I have provided several ticker symbols in this presentation. You can use them for your further research. Hello, my name is David Das. I have been involved in the stock market since 1999, and I have learned all these investing skills on my own. If I can do it, you can do it as well. There are 4 main sections of this video. We'll talk about math first, followed by investment strategy. Number 3 will be what to invest in, and number 4, other things to think about. Just for a few housekeeping items, this video is not sponsored by anyone. All the links mentioned in this video is provided in the description below, so you do not have to write them. If I'm too fast, you can pause the video and take some notes. The video is for educational purposes only. I'm not a financial advisor. Please do your own research and invest accordingly. So the first part of this video is talking about math. So how much we need to save, what kind of rate of return we need, and what is the time horizon. You're right, compound interest and dollar cost averaging will be the drivers of this strategy. As Albert Einstein once said, compound interest is the 8th wonder of the world. We will talk about 3 hypothetical situations. All the situations will involve initial investment of $500, monthly contribution of $300, and we are looking at 30-year window. And the 3 things that will change will be 10% annual rate of return, 12% annual rate of return, and 15% annual rate of return. You can use any compound interest calculator that you like, but I have used the one that I have indicated on the left side. The description has the link to it. The first item we have entered is the initial investment of $500, followed by regular contribution of $300 monthly. We have assumed 10% rate of return compounded yearly, and we have 30 years of window to grow the portfolio. And the result, as you can see, it is $627K at the end of 30 years. Now we are going to hypothetical situation number 2. Same thing, $500 initial investment, regular contribution $300 monthly, but the interest rate we have changed that to 12%, compounded yearly, 30-year time frame, and the result is $930K. In hypothetical situation number 3, same thing, initial investment of $500, regular contribution of $300, but the rate of return is 15%, 30 years to grow, and now you can see your total portfolio value will be $1.7 million. This slide is a graphical representation of all the results we just saw. With 10% return, our value is $627K after 30 years. With 12% return, it is $930K. And with 15% return, it's $1.7 million. It's almost 3 times the 10% return. Now keep an eye on this number here. 10% rate of return for 30 years, it grows to $627K. And if I change this number from 30 to 35, see how the numbers change. So if you invest 5 more years, the result is over $1 million. So initial investment of $500, $300 per month, 10% annual rate of return, 35 years to grow, and you are over $1 million. Now, if we increase the monthly contribution to $500, you can achieve $1 million with 10% return in 30 years. $1.5 million with 12% return in 30 years and over $2.8 million in 30 years at the rate of 15%. So the key points that I'm trying to mention here is if you save regularly, invest early, be patient, compound interest will be your best friend. And we really need to find something that can generate an annual rate of return of about 10%. In real life, people will start small and they will increase their monthly contributions with time as their earnings grow. Now we are moving to the part 2 of the video, which is the investment strategy. So we are trying to find a low cost, low to medium risk security which can generate an average annual rate of return of 10%. As we all know, Warren Buffett likes S&P 500 index funds. If you want to hear his advice to the new investors, please go to this YouTube video and watch the segment from 124.05 to 132.55. So what is S&P 500 index? Basically, it is a basket of 500 largest US publicly traded companies. It has your favorite names such as Apple, Microsoft, Amazon, Facebook, Tesla, and others. It covers stocks from all the 11 sectors, so it is well diversified. So if one company or one sector goes down, the impact to the fund is minimal. Now we will look at the performance of S&P 500 index over the years. According to Morningstar, for a 10-year period, the average rate of return was 14.12%. For 5-year average is 15.09, 3-year average is 14.78, and 1-year average is 29.83. And these are the numbers which represent the rate of returns for every year since 2011. As you can see, in 2018 and 2015, the rate of returns were negative. Otherwise, they are very good, 10% or more most of the years. Motley Fool has done a study to find the annualized rate of return for the last 10 years, 30 years, and 50 years. And they ranged from 10.7% to 13.9%. The Business Insider did an interesting study and they picked 30 non-overlapping years and tried to find the average rate of return. Between 1926 and 1956, the return was 10.77. Between 56 and 86, it was 9.63. And between 1986 and 2016, the average was 9.99, in spite of all the recessions and the bad news. The key point of the study is that if we track the S&P 500 index, there is a high probability that we may achieve an average annual rate of return of about 10% over the long term. But please keep in mind that there is no guarantee that this will happen again. We have looked at over 90 years of data and we saw that an average rate of return of 10% is possible. Now we are moving to the third part of the presentation, which is what to buy, because we cannot buy the S&P 500 index directly. We have three options. We can buy all the 500 plus stocks, or we can buy ETFs, or we can buy mutual funds. But buying all the 500 stocks for a beginner seems a bit unrealistic. So we will focus on ETFs and mutual funds. This diagram shows the similarities and differences between mutual funds and ETFs. You probably know most of it, but I'd like to highlight 2 points for each of these instruments. For mutual funds, you can set it up on an autopilot. It means you can provide instructions to your broker to withdraw your monthly contribution for buying your selected mutual funds on a particular day. And second item is that mutual funds are not traded as a stock or an ETF. It is only bought and sold once per day, and that is at the end of the day. The ETFs, you cannot set it up on an autopilot. You have to physically go to the brokerage platform and buy ETFs from your savings on a particular day. If you do not have a zero commission broker, this will cost you money every time you buy. Good thing about ETF is that it is traded like a stock, so the price varies during the day when the market is open. I'm going to talk about a few low-cost mutual funds and ETFs that track the S&P 500 index and traded in different currencies. This table shows 2 mutual funds in US dollars with a very low management expense ratio. Here are 3 low-cost ETFs traded in US dollars. Please note that the first 2 of them have a significantly lower management expense ratio than the SPY. These are Canadian mutual funds that track the S&P 500 index. Note the management expense ratio of these. These are significantly higher compared to the ones traded in US dollars. Also, for each of these funds, there is a regular version and there is a currency neutral version, and we'll talk about that later. The Canadian ETFs that track the S&P 500 index, this is a list, and these are very good compared to the mutual funds in terms of management expense ratio. And if you are in other countries and you want to track the S&P 500 index, these are some of the names that I came up with. And if your country permits, you can open a USD account and trade the mutual funds or ETFs that trade in US dollars. Here are a few tips for Canadian investors. If you find these to be complicated, please seek professional help. But I'm giving you my 2 cents on these 3 tips. For tip number 1, which is on withholding tax, I will put US listed funds inside my RSP, then I don't have to pay the 15% withholding tax on US dividends. The US listed funds also have relatively low management expense ratio, so it's a win-win situation for me. Tip number 2, in order to convert Canadian dollars to US dollars, you have to pay a fee. In order to reduce the cost, there is a process that you can use. It's called Norbert's Gambit. On tip number 3, which is currency hedging or unhedging, my 2 cents is that if I'm investing for the long term, I will go with the unhedged version of the funds because I do not want to time the market for exchange rates and not pay the extra fees for hedging. There are few other things to think about. We all have to deal with the following: the inflation, the income tax, and the interest rates. We do not have any control over these. But what can you do which are under your control? Save as much as you can, start investing as early as you can, and think long term. So now it's the time to take action. Number 1, save regularly. Even a small amount helps. Open a brokerage account if you already do not have one. Do research and pick a low-cost index fund. Invest regularly for the long term and watch your portfolio grow. So my 2 cents: have the desire to learn and take action. Do not get hung up in small details. Just get started. So thank you for watching. Hope the video was useful. See you next time.